Wake up, motherfucker.
Yo, what's up? Okay, let's see. All right, I think everything's working. Okay, yeah, they changed up the whole thing again. They introduced this new Polymarket thing. What the hell is this? Oh, cool. Now I can put up a Polymarket banner. Wow. Let me promote gambling. All right. Anyhow, I'm streaming on YouTube. Is this legal? Can I promote gambling like this? Oh, okay, better not. All right. Wow. Everybody's into the gambling now. Everybody's gambling. Yes. All right. Let me see if I can figure this stuff out here. Oh man, where the heck? Hold up. Hold up. Hold up. All right, hold on. Let me get this crap up. Okay. All right, let me see. Get this, dude. Get this going. Okay. Back on here. All right. All right. Okay. Let's see. Let me see what. Let's see. So I was just looking at this. Okay. All right. So I'm gonna give you this Polymarket thing. Let's see. So federal prosecutors have charged Michelle Spagnuolo, a Google security engineer, with fraud and money laundering for making over $1.2 million on the Polymarket. Okay, all right. Okay, so that's what's gonna happen here. Now, I don't know if this is exactly like insider trading or not. So, but he's got charged with the, let's see, what is it? Commodities fraud, wire fraud, money laundering. Okay, so that's what I see here. So let's see, unreleased internal Google search data. So he made it through wagering $2.7 million on the outcome contracts, including correctly betting on the year's most searched person. Okay, so yeah, that's the thing. It's like everything here is like a gray area, so I don't even know what is even going on with exactly how this thing is treated. So like I said, like Ripple had a long court case about if it's a property, is it security, is it a commodity. So all these things go under different rules. Okay, so down here it's like, would you like me to know, or whatever, would you like to know more about the regulatory changes impacting prediction markets on the specific details of how the U.S. Commodity Futures Trading Commission, CFTC, oversees these platforms? So if it's commodity, it's under the CFTC. If it's a security, it's under the SEC. So that's stocks and bonds. They're securities. Futures and commodities, all the gold futures, all that, silver futures, oil futures, corn, soybeans, they're all under the CFTC. So I guess the poly market is under the CFTC for now, I suppose. I don't know. It's also based on crypto, and that's why this whole gray area is weird. You know, that we have wash sales. So if you know about wash sales, if you buy and sell something at a loss within 30 days and you buy the same thing within a window of 30 days, then you will have to give up that loss. So that's called a wash sale. But because crypto hasn't been declared a security, it doesn't go under these rules. It's not a commodity either. It's not a futures. It doesn't go under the futures rules. It's a property, so it's like a Pokemon card. So it's like, I don't even know what the heck's going on, you know, with all this stuff. And I kind of feel like they leave stuff in the gray area, kind of like the weed with the Schedule 1, Schedule 3 change. So now if you have a business that has to transact and you sell or buy marijuana, you procure, you grow, whatever your business is related to that, now you can go into a bank and get an account. They'll let you do that, at least nowadays, since Trump changed the scheduling. But still, it's still a gray area, right? You have state laws, municipal laws, and federal laws all like saying different shit. And so I feel like a lot of these things are done on purpose to keep you from making your own smaller version of Polymarket or small businesses from actually doing stuff. You can't compete with the big guys, and yeah, that's why I feel like they purposely do this gray area stuff so you can't make your own, right? Um, yeah, there's only Poly Market and the other one, Kelso. I don't know. It starts with a K. There's another betting market out there. So anyhow, yeah, that's it. I don't know. I'm just complaining, I guess, about all this stuff. It's just so weird. So this guy just goes in there, gets the search volume ahead of time. He freaking uses that to $1 million, which is weird in itself as well, because like if you're in Google, you could just work your way up the corporate ladder and get yourself $1 million worth in Google stock. Like eventually, like why do you risk your ass just to make a quick $1 million? And I'm assuming you're smart enough. Maybe he's not smart. I don't know. You could be talented enough to find another way to make a $1 million quickly. But no, you had to do it this way, which flagged the Southern District of New York. Good luck with fighting that court, man. Holy shit! You're going down like Sam Bankman-Fried level here. They try to make people an example of people, you know. But I'm sure Goldman Sachs does the same thing. J.P. Morgan does the same thing. Morgan Stanley does the same thing. BlackRock does the same thing. Blackstone does the same thing. They get slapped on the wrist and move on. Weird, totally weird. I don't get it. So yeah, I don't know what the Poly Market, the whole freaking wait list. I don't know. I don't know anything about it, but it's based on crypto. Okay, everything's based on. If you have a wallet, I'm pretty sure you can technically trade it offshore pretty easily. You know, you can dump your wallet in a custody in some other jurisdiction, trade, bet outside of U.S. jurisdiction. I mean, if you got you can easily get dual citizenship. If they really need you to prove that you're not a U.S. citizen or like you I mean, I don't know. There's a whole game played. You can always just do it like that. You can just say, "Yeah, I'm not a U.S. citizen," and you can have a Dubai citizenship, and you'd be like, "Yeah, see, here you go. I could trade over here." And I don't know. I don't know exactly though. How did even? I mean, look at his name. Michel Spagnuolo. Michel. I mean, it's French, Italian. It could be either of those, right? So I don't. Well, I mean, Google's a multinational company, so there you go. I think the problem is if he does have dual citizenship, then he got screwed. Yeah, right. That way, you could try to do this and just pretend you're not a dual citizen. That's what most people will do. They'll just leverage the fact that they have multiple citizenships, but they won't tell the company, they won't tell Polymarket that they have a social security number and all this stuff, right? But if they find out, like this moron did, that's my guess. This moron, he did something dumb by cheating in the Polymarket, and then they digged into his records and they found out, yo, you're a U.S. citizen, so now we're gonna snitch on you to the CFTC, the New York fucking Southern District, and now you're in trouble. Great. So yeah, I don't get it. It makes no sense. It makes no sense to me. Like it's just $1 million. Silicon Valley engineers can make $1 million any other way. What the fuck is this? The risk reward here was not good at all. If you just wanted to bet randomly, like, yeah, I want to make a little bet here or there, and you know, if you didn't get caught, you'd be fine. But doing something like this and you got caught, yeah, that's the problem. So there you go. Anyhow, that's enough of that. I was just ranting.
but I haven't looked into it. But I think it's the same issue as the crypto. You know, certain exchanges don't allow you to crypto exchanges don't allow you to open an account if you are a U.S. citizen, right? So I think it's the same reasons. It's pretty much the same reasons. But some people do lie. They will lie and pretend they're not U.S. citizens and to these things just to open accounts in. Most people are like, oh well, there's only Coinbase for us Americans. Well, yeah, you can get other exchanges. I mean, after FTX blew up, and then after what's his face from China, that one I forgot. That other one, Binance, right? That was the other one. Yeah, that guy had to go to prison a little while too. But anyway, okay. What's there to talk about? All right. Yeah, there's not much to talk about. Like, I mean, you could tell right away. We're just in options land, man. It's like you go up and then you get stuck. Like if you look at the SPY, it's so obvious. It's so obvious, you know? It's just like I could just look at it like, damn, SPY or the QQQ. If you just look at it, you're just like it just goes up and then it just gets stuck. And it's like, damn, dude. It's already starting to roll over that Monday. It's like, damn, man. Like we can't even just keep going. Like any other market, you can keep going, and that's why I said like last time, if that Monday we had a crash and we just fished like completely flushed everybody out, we probably wouldn't have this problem. You know, all this stuff is caused by the options market. This whole thing here is just like, dude, this is so disgusting. But you could see like I drew this gray thing just to as an example of what I thought like the S&P would do. And look, it's following it kind of. It's probably going to do this until all the options are gone. All the options are gone. Even next week the options are not completely gone. Even next week the options are not completely gone. Because the JP Morgan caller is still in charge until the last trading day of June, which is what? Wednesday, Tuesday the 30th. So this crap might keep going like until we finally clear all that trash out, and then we could continue doing something. Either we just continue going up a little bit more, and then when we get closer to August, we just go down. You know, that's my guess is what's going to happen. But all these options is just ruining all the momentum right now, completely ruining it. And we got no choice but to just sit here and go like, oh, okay, well, like you can see here in the QQQ. Look at that. Look at that thing. Look at that thing. It just goes up and just gets slammed right here, flat. It's just flat. Yeah, can't do nothing. Can't do nothing about it then. Lame. Completely lame. So, sorry guys. Gonna have to wait till next week then. Nothing's gonna happen. I don't know what Kevin Warsh is really gonna do. If he crashes the market, or if the market just wants to crash, just to crash for crash sakes, then yeah, you gotta wait until probably Micron earnings next week. You know, so let's see, Micron earnings. They were trying to pump that thing really hard on Monday. Yeah, they were trying to pump that thing really hard on Monday, for sure. But it completely failed today. I don't know. They were going hard on Western Digital. Western Digital. They were trying to pump this guy really badly. They were like, yeah, keep pumping this. That was like 15% Monday, and then it was like freaking another 10 something percent today. Yeah, they were trying hard. They were releasing a new price target, saying like memory is gonna be a big in big demand. All this nonsense. It's like, what the hell? You guys are nuts, dude. You guys are really nuts. You're just trying to pump all these guys before Micron earnings, aren't you? And the Micron, the main one, you know, it's just it still can't get to 1,200. It's just like, what the hell, dude? My target of 1,000 is still there. It's just like he can't even break out of it. He can't break out of this thing. It's like, fuck these people. Terrible, annoying. So let's see. Like, look at Intel, right? Look at Intel, right up there. It goes right to the top of that, right to the top of that range, and then just gets stuck immediately, and then goes back down. Yeah, that means, you know, there's a lot of options out there, for sure. A lot of options at this 130 area, huh? It's probably this 130 area. Everybody that set all these options right back in May is still there. And you have to wait until all that crap gets flushed out now. It's just like, come on, dude. Get it together. So, yeah. So if you can't tell my hatred for the options market, that's what it is. The whole options market really ruining everything. Really ruining everything. Like, you have to wait for all this stuff to get cleared out. So, yeah. But overall, this is why you don't want to have this kind of complex type structure here. So this thing here is complex. This was a lot simpler. See, you just went down, up, down, and then continued up. But here you had down, up, down, up. So whenever you have a more complex structure like this is no good. You just want simplicity. Everything should just be on a trend going up. If you want the trend to continue, you can't have complexity like this. This was the last time we had options, was here, right? This was a major issue going into the May options. This was the May options. And now with the June options, we didn't even hit the options expiration yet, and it was already doing this on the first week of June. The first week of June, we already started having trouble. And it's like, oh man, dude. And so now the closer you get to the options, you know, you're just gonna have to do this. You know, you just do. Because you made such a complex move here, you're gonna have a complex move over here. That's the problem with that. That's why I didn't like this. I didn't like this at all. I'd rather have had it just go down in 2 days. Like 2 days, I want straight down. If you went straight down and you went straight back up, it's more simpler. And then all the options guys over here would have got flushed out. All the call options. But because all the call options didn't get all flushed out, I bet all the call options are still here. All the call guys are still here. And so now we can't get above this wall until all these calls get killed. And the only way they get killed is they have to get expired, because all these people are still holding up here. Fuck. So there you go. So I think you understand now what's going on. So these options create these barriers, artificial barriers here, that you have to get around. So until like we get through this week, and then even this week, I'm not even sure if it's going to get cleared out completely, because the JP Morgan, the calls of the JP Morgan are all the way down here. So some people might be thinking like, well, you know, maybe the market has to go down here to clear those options out. Oh my God. So yeah. So if you remember, let me see if I can get that whole other thing. JP Morgan, JPMEQX. Oh man, what was it called? Okay, let's see if it works today. Last time I tried putting this into TradingView, it didn't work. All right. Okay, go. Give it. Okay, I guess that's better than last time. All right, let me switch out. Let me go over here. Okay. Okay, let me go this. So you see this? This is what happens when you buy the JP Morgan Hedge Equity Fund. This is a product that protects you from the downside instead of having the S&P. So you could buy the S&P, right, with the SP, the VOO ETF, whichever one you want. So let's see. So I could add that to it, right? I could do the SPY. So here's the downside of using this. This is the downside. This is the downside here. Okay. So the theory is that if I buy this, you know, it protects me from the downside. All right, it protects me from the downside. Let me see. I don't know. They're not the same scale, so I'm trying to wiggle my way here. I guess I could put this on the same axis, but let's say I bought this around the same time in November, right? The November dip, right? And so, man, is this a fair comparison? I don't know. I don't know if this is fair. I wish there was a. I guess I should put it in the same scale, but then okay, I got to put it into 100%. All right, let me ruin this. Let me index this. Oh, okay. I don't want to ruin this whole thing. Let me put this in the same scale. All right. Let me see. How do I do this? How do I do this? Put this in the same damn scale. Percent. Okay. Do I leave it in a separate scale? Let me see. I don't think I can move it once I do the percent. Okay. Let's see. Is this a fair comparison? I mean, so if I bought the JP Morgan equity here, I made more money? Is that fair? Is this a fair comparison? Man, I really need to investigate further how fair it is. I mean, all right. I guess I'll just put it in the same scale. Merge all sales into one. Okay, fine. But I don't even know if this is really fair. Is this a really fair way to compare? But then now it's like auto locked like this. It's just like, oh my god, come on. Okay, dude. Okay, undo it. Forget it. Let's just look at it this way then. I don't know if this is a fair comparison. But I mean, the most important thing to look at is that you see this flattening, right? I mentioned this before. This flattening effect that you have here, because this is where the call wall is. Okay? And so you bought calls to fund your puts. That's basically what it's doing. And so when it goes down, what you want is that like it kind of protects you from how much it's going down. It's kind of like, oh, it's a little bit of a cushion. That's the theory anyway. I don't know. I'm not an options guy. I don't know if this really works as well as they claim it could work. And like you go down a few percentage towards the puts, where the puts are, and so it wouldn't punish you as much as if you bought the plain VOO or SPY. ETFs. But here's the drawback: when the market goes higher than those calls, those at the location of the call wall, you see what happens. You make no money as the S&P goes up. So all the people here did not benefit at all since mid-April, when the semiconductors pretty much took over all the gains of the S&P 500. So they've been pretty much flat. They've pretty much flat since mid-April. They didn't get any of this gain in their portfolios. So anybody that bought these hedge equity funds, they missed out. They completely missed out this whole move here. And people theorize that a lot of people buy this instead of buying the S&P. So there's a lot of options that are still there, right? That have to get wiped out this week, and then they have to figure out how to make them into into new options for at the end of the month. So I don't know, all those changes, it could affect things too. So this is really painful to me, honestly. I feel like this whole thing is like stupid, really wastes my time. So we have to suffer through all this noise. Yeah, great. So right there, we get stuck. We get completely stuck in this hellhole here. So yeah, I don't think we can break out of this. I think we just have to keep bouncing around this thing until the end of the month. Is my guess. So yeah, that's all I gotta say about it. Really annoying. Anyhow, oil's going down, but is it time to buy oil stocks? No, probably not. Probably July into August. I'll look at them again. So let's look at some of our favorites here. Let's look at this. Hut, still stuck. What do we do? Still stuck. Trend is still good, but we're still stuck until the options are gone. Core Z, good too. Still stuck. CIFR. Damn, almost. It's trying. This thing could be the new number one, CIFR. NBIS, thank the Lord that it got added to the NASDAQ 100. So it's a lot better than its cousins over here because of that news. So it's been dangling up here, right? The only problem is it can't get any further, probably because options. But at least it's like it's staying close to here instead of dangling over here. If it was over here, yeah, that'd be a little bit more concerning. But it's doing a lot better. APLD, yeah, almost today. Yeah, it could have, but it got slammed back down. Oh, IREN. Nope. This thing still has trouble getting far away from here. Wolf. Let's see, Wolf. Yeah, this one's doing well. I might put this up higher. I think this was like one of the ones that I didn't pay too much attention to until, like I said, well, okay, now it's improving. Because after this move here, at least it got out here. But you can see like how ugly it is. It's like it's way too. Wow. Okay. Yeah. This is kind of nasty, but at least it's doing this week. Okay. So I'm still kind of on the fence about this one. Rumble, like I said last time, no. I think this candle here last week was too much. This is too terrible. You just cannot expect a strong stock when you go to resistance and then you fail. You know, you open here, you go here, you get over to resistance, right? And then you just close the day down here. No, that's what that candle represents, with a lot of volume too. That means you're stuck here. You're really stuck here. Okay, let me talk about some healthcare stocks. We got HIMS and mRNA. HIMS is doing really good. Perfect. So this whole range here, it looks like it wants to get out. Okay, so and we got mRNA. It's going back. It's going back up. Right there. There's no hantavirus anymore. But look at today. Look at that. So, when we had the hantavirus thing, I was like hoping it could just stay up here. So I didn't expect hantavirus to be anything realistic. Like it wasn't going to be any kind of like pandemic. But even with hantavirus, like the news cycle disappearing, it would still stay like making a new range at the top, of this kind of uglier. I don't know what to call this. Like, I don't even know if I want to call this technically some kind of a range, but I assume it would be. If this thing continues, it would just keep doing like this. But if this time around it does stay, that's it. So I think by the time we get to September, closer to the elections, I would expect like there's going to be a subtle shift start taking over in the healthcare sector. So small cap biotechs, and if like Kevin Warsh is really not as aggressive on the interest rates as people hope for, if that's really true, then yeah, these stocks will be doing well. Like I said, like why are real estate stocks improving so much? If people really were worried about interest rates, this sector should have went back down already. But it's been dangling over here and it's starting to move up here. So what's that? And let's look at the ITB home construction. There was bad news for home construction this morning. There was like, oh, there's not much new housing starts, so people are not planning to build much out there. But if people are really afraid of interest rates staying high or going a little bit higher, that would be one reason why builders won't want to build, right? The other reason would be is like they just don't want to build because inflation right now, right? They're waiting for inflation to stop peaking because of the oil issues. That could be another reason. They're just afraid. They're just like, well, if we wait out a few more months, like prices for materials should start going down. So that could be another reason. But again, if interest rates were a big thing, this thing should have went down already. All right. So another interest rate sensitive thing that we have to worry about. Okay. Anyhow, gold still doing well. I think gold definitely. We had the Bank of Japan. The Bank of Japan had its little thing here, and it's doing fine. Let me get back to the logarithmic. Okay, and get rid of that. I think this is probably okay. So let me look at the little indicators here. I think that's the problem, is like the red DI is still strong. Like it's been strong since this. So it hasn't improved. I mean, if you just looked at indicators, right, you probably were not that bullish. Unless here and here. Those were the two times that you were hoping something would change, but it didn't, right? It just didn't. It just really didn't happen. Those two times were the other times. Now we're getting to the point where, like, okay, it's trying again. Trying again. Okay, so are we ready to move up to the top of the range now or not? So that's what you're going to be watching for Kevin Warsh tomorrow. Kevin Warsh should tell you, like, yo, what is your future interest rate policies? What are you planning to do? The Bank of Japan already gave its policies. It's going to raise its interest rates. How about you? So we cleared the Bank of Japan. It's fine right now, and I don't see anything crazy with the 10-year for the Japanese bonds. I don't know about the yen right now. Nothing here either, so I don't see anything either. So nothing wrong there. So yeah, I should see gold at least try to make it in the next couple weeks. All right, that's it. But that's as far as I'm gonna bet on it. It's just gonna hit its head on the top of the range and get stuck again. That's my bet. Bitcoin is gonna be a lot worse than that. I think Bitcoin is in a nasty place. I mean, overall, like, look at this thing. This was a stronger candle right down here, right? This was a lot stronger. Yeah, I mean, this whole response was a lot stronger. Once it hit this area, it just bounced completely back up, and that set the motion for this range right here. Here, it's just like, dude, it just fell right down. It just can barely crawl back up. Can't even get to here within like a few trading days. It's like, bro, this is weak. Very weak. You know? So, yeah, that doesn't give me much confidence, man. And Bitcoin and Ethereum, all those trading futures market, options market for crypto, they end at the last Friday of the month. So next week. So you're gonna have to wait until next week to see what's up. So last time, this was the expiration right here this week, right? And then after it expired, it just crashed. So it waited for the options market to finish up, and then it crashed. So now we're gonna wait until like what? Until here, and then what's gonna happen there? Is this gonna crash even lower, or is it actually gonna try to go higher now? That's what I'm wondering. So this is not giving me much confidence the way it's acting here. This is pathetic. This was a lot stronger, and even with this strength, it had to like go sideways for how many weeks, right? How many weeks? And now you're even weaker, and you're gonna tell me you can go even higher? No, you can't. The gold is doing better than you right now, so that already tells me a lot. There. So how many days was this one? 67 days, right? 68 days, right? And you divide that by 7, right? You can get that. So that's about 9.5 weeks or something. So, dude, that's a little over the freaking that's about 2 to 3 months. So I'm guessing what's going to happen with Bitcoin. This is my guess based on cycles, because usually a bear market in crypto takes about 400 days, 400 something days. You know, a little over a year. So from the last peak. So let's say this is the peak of that cycle, right? I'm being generous now with this, I guess. So I'm gonna say like over there. So maybe at December, sometime in December, it will finally hit a bottom. Okay. So something like that. That'll be a real bottom. So I would say, like, if this thing does try to go up here, don't be fooled into August. Okay, so it'll trap some people here thinking this is over, and then it'll just make a real new bottom down here. But again, it could be that people are so bored of crypto, they don't even pay attention to crypto anymore. It wouldn't even make a new crash. So a lot of people still believe like crypto is in Bitcoin specifically. It's in a stage where it could just go right back down to 20 something thousand. And my guess is that maybe it'll just keep going sideways until then. If, maybe there will be a point where it touches 45 and then bounce, but it'll probably be short. It'll be like it'll try to stay sideways. Maybe there'll be like a painful 2 weeks where it just makes a crazy dip and then come back. So yeah, probably December or something, January you could go look at it because it follows a cycle. So that's it. Any specific sectors that market analysts are seeing money move to out of tech? No, not now. Nothing. Tech, it's all in tech right now. Tech is where it's at. I don't feel like yeah, I don't feel like there's gonna be anything that would happen. That's really important. In August, I'm just gonna go back into oil probably, and that's it. Yeah. But outside of that, nothing. I think this aluminum area, let's see, is pulling back. I know AA is pulling back, Alcoa, but the ones that are like the ones that I recommended scrolling underneath, right? Like that one, those ones are gonna be like more stable. So let's see. Kaiser, I think Kaiser's still fine. Like that chart is still strong. Yeah, see, Kaiser's still strong. This thing's still strong. So I don't know. I'm not changing my mind on that. RS still strong. CSTM still strong. So is there even more money going to rotate into this stuff? I don't know. But right now, everybody's in tech anyway. It's just going to stay in tech for a while. You're not going to see any meaningful move until next year, I'm thinking. That people might be getting ready to position themselves into healthcare. That's why I'm hoping to see. I'm hoping to see healthcare get more of a signal here. Right now, I don't see a signal, right? I'm looking at XLV over SPY. I don't see a signal here. So, like, that's what I want to see before I'm really confident. I mean, that's what we saw with oil. Oil, we saw that. This thing was already moving in January, February. So now it's pulling back. What you're going to see here is that it starts stabilizing somewhere here and then move back up. That's what you want to see into August, September. But yeah, everybody's in tech. They're going to stay in tech. They're not going to get away. Is the whole software rotation still looking like, I don't know anymore. Like, outside of cybersecurity, it doesn't seem anybody wants to bite it. Maybe we'll see some change later on in September too. We'll see something change, but right now, nope. Like, it just gave it all away. Like, IGV just gave this all away. So unless you just look at cybersecurity, hack or bug, I guess bug. I can look at bug. Like, this is better. This is better. This is a lot better here, but still not much better. But yeah, cybersecurity is doing good. But yeah, IGV is terrible. That's it. If you just look at IGV versus SPY here, like, dude, you went all the way here. You went all the way here. So IGV divided by SPY, and you just crashed right back. So it's like, if you cannot beat the S&P 500, why do I bother looking at the stocks in your sector, right? Why do I bother? Like, semiconductors is still king. Semiconductors is still king, right? This is the leading sector of everybody. Like, what else? Where else would you want to look? I'm not going to look at discretionary. It's not doing any better. No. Nope. Why do I look at that? Staples. So you could do this yourself. You could look at every sector in the S&P 500, look at the relative chart. You just look at it, divide by S&P, and you can say like which one is doing better. There's only one at this moment. Banks. Let's look at the banks. See, this one's kind of trying to improve, right? This one's trying to improve. Banks is still trying to improve a little bit. Banks, insurance companies, but it's still not like the leading sector. So IBB divided by S&P. See, this is the biotechs. Nope. See, nope. Ever since April last year, you see that? Nope. Why would you get in there, right? See, nope. Let's see, real estate. Nope. Let's see what else. Utilities. Nope. No improvement there. So yeah, it's hard pressed for me to find any improvement. I think XLI probably is okay. Oops, my bad. Yeah, XLI is trying. It's definitely trying. You see here, it's trying. That's why I like Deere, I like Caterpillar, I like GE, Veranova. Like there's definitely good companies in the industrial sector, but it doesn't beat semiconductors though. So it's hard for me to go like, well, yeah, buy other stocks outside of tech. I mean, I can't really. Everything's in tech right now. Shit. So I know it's not good, but I know it's not good to be concentrating your risk in one area, but right now it's like you're not gonna make enough outside of tech to justify just staying outside of tech, right? If you're just afraid because like it looks like a bubble, the problem is like if the bubble is gonna get popped, everybody goes down with it. So even if you hide out in these sectors, when semiconductors goes down, it's gonna pull and drag the S&P down, and it's gonna pull and drag everybody down. So yeah, there's no value or benefit to be hiding out here right now. And even people have said like they've done the valuations on industrials that these companies are overvalued. So they're going like, well, historically industrial stocks are kind of overvalued right now. So that really doesn't give me much, you know. It did well in 2025. Yeah, you see here 2025 was doing quite well, but since the tariff stuff, it just hasn't really done as yeah, I mean, I don't know, it's trying to recover, but outside of a few stocks like I've mentioned, right? So GEV, very good. Nuclear, energy, turbines, all that stuff. It's just like, yeah, good. You know, this has done well. This has done pretty nicely. But these are not common in the industrial side, like CAT, yeah, very nice range, yeah, but this is not common. Deere is in a range, you know, for a long time, but I still like it. I kind of like think this has been in a long-term range for such a long time, you know, since 2021, 2022. I don't know, it depends on where you want to start it. That once it breaks out, if it can break out here, that's pretty good. So eventually it will. I mean, a lot of these industrial companies have already started doing a lot of AI and things like that it built into their products. So they're actually data collecting type companies now, you know. So Caterpillar and Deere actually track where their tractors and excavators are doing, or what they're doing, where they're going, so that data can be sold to other companies for money. So if you look at these companies, they're not just like selling you a simple tractor, they're tracking your ass. and selling that data to another company for cash, right? For a fee. So they're making revenue off of that. So yeah, there's plenty. ITA. Didn't we already look at that? We already looked at that, right? That's the defense stuff. Yeah, we already looked at that last week. And I said like, yeah, see, we already looked at that. I said like this is already blew off because we already had the Iran war. So now it's just gonna go sideways before the Chinese war probably. And so you probably can accumulate later on, but yeah, this is not the war is over, so we're gonna have to wait for the next war cycle, which is probably in another several years down the line before we hit off. So there's nothing there. But yeah, you can look at more of these yourself. I mean, I don't know what else. I already looked at the XOP, looked at that. Energy I already looked at. I think I already looked at all of them. Come on. Let me see. No. But yeah, this is something you should do every quarter. You should look at all the ratio charts and go like, oh, okay, this is everything here, S&P, like all this stuff. Yeah, I think I already looked at all of them, so I don't think there's anything else. I mean, you should start looking at international stocks at this point. Start looking at international. Okay. One more is like XLB, right? Materials. This one, yeah. I mean, if this thing improves, then we can start looking at more outside of aluminum and steel, right? So you have to look at copper, look at uranium, look at lithium. But right now, yeah, this stuff hasn't really improved. Yeah, this stuff hasn't really improved. So, all right. For me, the question was less about fear of a tech crash and more trying to get in early. No, there's nothing there. There's nothing there right now. Right now, there's going to be no new rallies until we have a crash. Like, the thing is like the only way you're going to know that money is moving somewhere else is during a crash. Okay? It has to be during a crash. So when the market goes down, you're looking for improvement in the relative strength of a sector versus another, meaning that it's going down less than another sector, right? So let me give you an example. Look at how semiconductors did during COVID. Okay, let's go back to COVID. If I was just looking at semiconductors by itself, so during here, so March, if I looked at this whole area, okay, let me get rid of the volume. Let's get rid of the volume. So if I look at this whole area, it doesn't look bad, huh? Like from a relative perspective, like the market was crashing 10, 20, 30%, right? At this point, depending on which week of March you were looking at. But if you were looking at the relative performance of semiconductors during this time, it doesn't look that bad. Meaning that the semiconductors didn't go down as much, right, as the rest of the market. So from here, February, the end of February to the bottom of March, top to bottom, we went down 8% relatively to the S&P 500. Let me look at another sector. Let's look at another sector around that same time. Let's see. So let's compare. What other sector will we go to? Let's go discretionary, S&P. Okay, let's go back to 2020. Okay. All right, let's see. Let's see. Let's see. How much more will it go? So this was about 9%. So a little bit worse. So this is discretionary. Okay, 9%. Let's look at someone else. Industrial. How about industrial? How was that doing during that March time? So that's what you would do. You would just start comparing. You would be like, and I'm just doing it in a nasty way. Like you wouldn't do it like this. I would think. This kind of crude. I would start pulling out the RRG charts from stock charts. You go stock charts and take out some RRGs, and maybe you could get a better read off of this relative stuff rather than doing it this way. But this is fine. This is fine. This is good practice. You know, you should start like thinking this way. So XLY. So end of February into the low of March. 12.8%. So this is worse than discretionary and semiconductors. So yeah, I could go on and on and on and keep doing this. So I could find out which sectors during that crash did the best. If they did the best, then I'm thinking, well, that means somebody was buying when it was going down to prevent it from going down even worse than these other sectors on a relative basis. So I could use that as a way. I mean, this is a cheap way of doing it. This is not a really, like, I guess, more accurate way. The more accurate way is like you have to have data of like people actually buying stocks, right? Which we don't have. We don't have that data. All we have is charts. So this is kind of a crude way of doing it, but it's a free way of doing it. I don't have to pay money to Goldman Sachs or somebody to get their data to figure out like who's buying this shit. Okay, that's it. Find a list of what the sector tickers are. No, there's you don't need to. You just go to the you just go to the S&P website. The S&P website has it. Oh, actually, no, you can go to stock charts. It's free. Stock charts is free too. Go to stock charts. You don't need to have an account. Here, I'll show you. Like I showed you this like at the beginning of this year too. So I showed you this like at the beginning when I first started this show, and then also at the start of the year I did this as well. So yeah, hold on. Okay. All right. All right. You see, I'm not logged in, so you should be able to do this yourself. Okay. So let's look at. Sector drill down. So I went to market analysis and I went to sector drill down. So these are the sectors: financial, utilities, industrial, materials, real estate, consumer staples, communications, healthcare, consumer discretionary, energy, and technology. So those are the sectors that they split up the S&P 500 into. Now we could go even further. We can go to industry. So you could take down that pull down menu. You could go to U.S. industries. and you can get more granularity. So communication services can be broken up even further into internet publishing, media agencies, fixed line communications, broadcasting, entertainment, mobile telecommunications. So you get the idea, right? We look at discretionaries. See, I can get toys, I can get hotels, I can get footwear. So when someone asks me about like Nike, it's like, well, I see Nike going down, but what about the other stocks in its group, right? How is Nike compared to the other guys? Like, tell me. So Nike is down 28%, but if I got Crocs, it's up 48%. So that tells me that, well, is it a sector problem or is it a U problem, right? This is a Nike only problem or what? I don't know. Of course, Nike just, doesn't only make footwear, right? And that's why I kind of go like, well, what about Lululemon and all those other ones? That's kind of the thing you got to look at. What about Lululemon? They kind of like compete in specific areas that overlap. So this is it's not always going to be perfect. Let's put it that way. It's not always going to be perfect. You can't compare companies exactly like other companies sometimes, because they do things that other companies do not do one to one, right? So that's why when you go look at like, okay, apparel, right? Clothing. So I could look at clothing. I mean, there's clothing and accessories and apparel retailers. So let's look at clothing, accessories, whatever. I don't know why Funko Pop is in there. Shouldn't Funko Pop be in toys? I guess not. You got Under Armour here. You got Lulu here. So I don't know why Funko Pop is in here, but whatever. Okay, they put it in there. But again, like, right, this is kind of like, I suppose that's an accessory, but that kind of targets a different group. Maybe they should make a new adult toys group or something and put the sex toys in that one too. But anyway, yeah, you got Fossil Group. They make watches. That's an accessory, but that's not technically the same area as a Lululemon, right? So again, this is kind of up to you to decide. This is kind of arbitrary based on how the Dow Jones and the S&P 500, how they group things. But this is a start. At least it's a start, a good way for you guys to investigate. Okay, no thanks. But yeah, you can do this for free. You don't need to you don't need to pay for this. This is free. I don't need to pay for this. So everything I tell you you should be able to do by yourself for free. You should be able to do yourself for free. Now, if you get more advanced, what you would do is you would get an RRG chart. So RRG is by Julius de Kempener. I mentioned this on and off a few times. I don't really go into this much because I don't think this is like something you should look all the time. You should look at it once in a while. So if you want to look at the relative strength of something, let's look at it. Let's see what we got here. So let me see. This is free. So let me see if I can, how much I can get away with doing something for free. RG. Wait, perf charts. Let me see. Man, I guess they took it away from the free version. Oh, too bad. Yeah, you usually could at least get the like sector rotation chart for free. I guess that's gone now. Okay. The other way to get this is from Bloomberg. So you either get this from Stock Charts or Bloomberg. And Bloomberg terminals cost like $25,000 a year for a subscription, so you're not going to get that. That's for sure. Let me see. I don't know. Can I even get it from here? Let's see, sector. Oh, okay. Can I? No. Damn, they don't let you do that for free anymore. Oh, that sucks. You could have gotten this for free. But it's not free anymore. Sorry guys, not free. They took it away from you guys. So now you can't do it for free. Oh well. I guess that's it. I don't know. Maybe I'll have to look into this. So I guess they took that away from you. Oh well. I've seen some videos of people using this RNG charts. Yeah. It's Julius the Kempener. He always has videos on there. I mean, I don't use it too much. But it is a better way of doing relative analysis. But like I said, like most people, it's just a crude way of doing it. You know, it's just not the way most real hedge funds will do things nowadays, because most of these hedge funds and institutions, they actually have real data. They actually have real data of who's buying what, you know. But the thing is, you guys don't have that data. So the only way you could get it is from looking at charts and going like, well, I think somebody's buying this more than the other, so I'm gonna bet semiconductors now. Ugh. That's how I do it, and I think it's fine. It's a perfectly valid way. It's just not like, it's probably not going to be a good way in the future, right? Because most people are going to try to hide what they buy, and a lot of distortion, noise from options. So I kind of feel like maybe doing it that way is not going to be good in the future. For now, it's decent way, but yeah, I don't. I don't know if I would tell you guys to spend so much time looking at it. That's all I'm saying. It's just like, bruh. Don't waste too much of your time. Don't think it's like the holy grail, right? Like if I saw that in a chart, I'll be like, oh yeah, of course. That means like I should go all in this sector. No. Maybe that's not a real signal, you know? You need more. That wasn't exactly the only thing I was using to tell you to buy oil in February. Like that was one thing that made me say like, yeah, that's a good buy, but it wasn't the only thing, right? I showed you different pieces of evidence showing that people were buying crude oil. One of the ways was using the CtC report. So the same organization that got the Polymarket guy, gave him a little speeding ticket there, going like, "Yeah, you cheated." They also give a weekly report. Okay, let me show you this. I'll show you this. So yeah, I guess that's not free anymore. So here you go. All right, let's see. So this is what you got from the free version, right? That's not what I want. So this is what I want. I want to do the sectors here. Okay, so I have all the sectors here. Notice something? What is the one in the green area? XLK technology. What about everybody else? Everybody else is red. So right away, I'm like, why do I want to buy other stocks? I'll just buy everything in XLK. And XLK is, you know, there's a lot of different ones in the XLK. Like, look at the one in the yellow, though. XLE, the oil, natural gas, pipelines. So this one was strong. It was strong at one point, and now it's weakened. But look at everybody else. Everybody else is weaker than oil. So, like, the only companies you would want to buy is like you flip flop between technology and oil at this point, right? That's what we saw this year. Now, if we go look back. So look back at the previous. XOK was strong July 2025, right? And we see it rotate. So what's going to happen now is that we're going to see, you see XLK, it's like it started weakening. So something was happening in February. You see? So for most of last year, XLK was strong. Okay, but then it starts slowing down. If you remember that whole Oracle stuff, and then by the time it got to January, guess what? Who was starting to creep up here? Oil was creeping up. The other one that was creeping up was healthcare, but that was short-lived. Healthcare died like right away. Healthcare was trying to get up there because of Ozempic. It was like the Ozempic stuff. It was like, oh yeah, okay. We're leading now. But then that was like it started rolling over, and then oil started taking over into March by that time. So you could kind of see, like, yeah, using this way, you could look for what's gonna grow, what's gonna weaken, what's gonna grow, but it's not perfect, and it takes time. It takes time because this is again a lagging indicator. Okay, I think the best time to use it is if it was during a crash. If we have like a big correction, and then you start looking for changes, that's the best thing to happen. Like, so when we were like going into a crash, you'd probably be like, okay, let me zoom in a bit, right? This is the weekly, so let me go to the daily. Let me look at the daily. Let's see what's changing on the daily time frame. So if I was looking at this crap, okay, during March, right? Like, let's get into March. So February, okay, we see that. All right, so let's get into March. So what was improving? So we see here. Let's focus on XLK during this time. So even while the market was moving down, right, into late March, XLK was still in the green and the yellow area, right, for a while there. Okay, now watch this when we got to the taco. When we got to the taco, so it was like it was staying mostly into the green and yellow, and then it was like, all right, for a little while there, it was starting to go red, but then it recovered pretty quickly. And that was it. Like by April 15th, it was pretty much the strongest one, right? Outside of industrials. So that would have told you something. It was just like, it's just way too strong now because everybody else was just completely weakening. If you looked at XLE, by that time, it was just like, dude, we were already dying out here. So we flipped from XLE, and then we started shifting over to XLK. So that's how you would look at this thing. So every time you make a little transition like this, you can just start looking at this and be like, which one's the strongest? Which one's going to be the next strongest? Okay. And then what you would do is you would look for like improvement. So XLK was trying at the end of March. Okay. And then once we got into April, it's like, okay, I'll keep following it to see what it does. And then all of a sudden, it just rocketed back up. So the only other ones during the time we had this dip that was trying to improve were banks and materials. materials. So like steel, copper, lithium, whatever, all those guys. But you can see like right away, they were curling down. They were starting to curl down. And it was only XLK that was actually going back towards the green, you know? And so if I just looked at these four guys, during that transition time, yeah, I could see. So it's up to you if you want to use this. You could use it. I just don't want you to be like spending so much time doing this though. You could just look at a chart and be like, okay, I see a chart. I see a chart. I don't like if I want to start doing RGs all the time too. It's just like, dude. Like this might be just too much information, you know. But for now, you can see like XLK is still strong, right? It's still well far away in the right side of the chart here. Like the only other one is healthcare right now. Like the only other one is healthcare right now, right? Healthcare is the one that's trying to make it out. It's like healthcare. So I don't know if healthcare, this is a temporary healthcare move, or if healthcare really wants to move. But yeah, healthcare would be the next one I'm looking at. So that's why I was like talking about HIMS today. I was talking about mRNA, right? mRNA, you know, I've been talking for a while. I feel like mRNA or McKesson, right? MCK. So these healthcare stocks I really like, but it's kind of a waste of time to get in there too early. Yeah, you can get in there early, but how early is early? You might be getting in there way too early. They might still just go sideways into next year because everybody still wants to go into SpaceX now. So even if like semiconductors is out of favor, it's just like they're just gonna go into another tech sector. They're going to space. They're just gonna go to SpaceX. Like, I don't know, right? They don't want to give it up. It's really hard for someone to just tell you, oh, go buy banks, go buy lithium, go. Dude, those things could easily just go up and then just go back down, and you're just stuck in a range again. You're just stuck in a range. You're just not gonna get that nice, clean push that like semiconductors or something else could do, you know, over time. So yeah, it's tough. So let me look at the XLK members here. So these are what's in the XLK. All the stocks here are in the XLK. Okay, so let's do this. So let me look at the weekly chart. Oh my god, this is so messy. Too many stocks. All right, let me just do the favorites here. Let me highlight the favorites. Let's do that. AMD, Nvidia. Like, let's just do these three. Let's just do AMD, Nvidia, and Micron. See that? Oh, okay. So now look, Intel's going up. Oh, Intel's going up. Okay. November, yeah, Intel's going up. Yeah, of course. But the thing is like, okay, what's the best one to get out of this? Like, only Micron is out here. Oh, Micron's dying. Oh no, Intel's got. Like, I don't know what you can get from this, really. Like, this is kind of like too much, in my opinion. I think this is useful when you look at the sectors, but when you look at the individual stocks, I think this is kind of like too much information for you. I don't think this gives you any benefit, really, per se, you know. So I wouldn't waste your time doing this. You could spend all day looking at every little RRG chart, but that's just too much, right? I think you have to quantify it somehow in a better form. Yeah. I think this is where AI comes in. This will help you, because this is just too much analysis paralysis right here. You'll just get sucked in here and you'll just stay here. This just doesn't really get you something. So that's why I just stick with the sector stuff. And it used to be free. I think the stock charts used to give you this for free, but looks like they took that away. So you got to pay money for this, just for the XLK and the XLV stuff and all that. No, I mean, come on. I don't think it's worth the money to pay for that. Come on. But anyhow, there's another way to look at it too. Let me see. Let me see here. Okay, let me do XLK. Let me show you another way of looking at things. Okay, let me see. Daily chart, weekly chart, monthly chart, minute chart, sample relative strength. Okay, let me do this one. Okay. Okay, and then let me add stuff here. Let me do here, relative strength. All right. You see these lines? That's the same stuff you saw on the RRG. So the like there was two dimensions, right, to that RRG. There was like a RS ratio and then the RS momentum. Here, let me put that back up here. So let me do the RG stuff, stock charts. Okay, let me go there. And let me do the RG. Let's do the sectors again, and let me highlight XLK. So this Y here, JDK, so that's Julius de Kempener RS momentum, and then JDK RS ratio. So you want both of these to be strong, okay? That's it. Now, if the momentum weakens, then it will just go into the yellow, okay? So it will go into the yellow like here. It'll just go into the yellow. That's where we're at here. So what would happen would be like sometimes you go green, yellow, and then go back to green. The worst thing would be like if you just go red like here. So both your RS ratio and RS momentum would be at a low number. So they all scale to 100. 100 is the baseline. So if both of them are 100, you are in line with the S&P 500. That means you're performing at the same level as the S&P 500. You're not doing better or worse than the S&P 500 if you're both close to 100. Okay, 100 on the RS ratio and 100 on the RS momentum. So you want your momentum to be strong, okay? And you also want your relative strength ratio to be strong. So relative strength ratio is basically like the division we do, right? We just do XLK divided by SPY, right? Or XBI divided by SPY. We just do ITA divided by SPY. That's the ratio, but the momentum is separate. So right now, you see the momentum is dying, right? Because we wasted so much time with this going sideways that the momentum has pretty much been weaker, than what we should be for the normal S&P 500. So the S&P 500 we are competing against. Everything we do, we're competing against the S&P 500. Because if you can't beat the S&P 500, why do we do this? If I could just buy the S&P 500 and just hold it, I beat you, then why do I bother picking stocks? That's the whole game. The reason you pick stocks is you think you can buy and sell stocks at the right times to overall you beat the S&P 500. That's what it is. When a stock gets weak, you get out. When a stock gets strong, you get in. And overall, you should be able to outperform the S&P 500 if you get in and out in a way that you can stay in this green area. Can you stay in this green area? Can you jump in and out, in and out, in and out, and pick the right sectors all the time? That's the goal, right? That's basically the goal. If I only had all these ETFs, if I could only pick all these ETFs, could I just basically predict and get in and out? Okay, this is weakening. I get out now. I'm going to get into healthcare now. Okay, I get into healthcare. You know what I mean? That's how it is, right? So right now, that's the only competition that I see: healthcare, energy, and technology. Those are the three that actually like try to get in and out of the green area at a point where it just stays in there, right? I could just like try to rotate my way around and beat the S&P 500 just by using 3 ETFs. Then I could do it. Can I do it? So that's the goal. So right now, you see the momentum is dying. RS ratio is still strong. Yes, technology is strong still, but it is weakening now. We're starting to go towards the 100. And when this thing crosses over, then that's it. We are done. So we've had a very good time since April 15th. You see here, that's when it really flew, right? The RS ratio really flew. But you can see the momentum, like it's been decreasing because we keep getting stuck. We just went up and we got stuck here, went up again, we crashed down, we got stuck here. So the momentum is dying. It's definitely dying. Does that mean I want to go look for something else? Well, I guess we could say like, well, what about space stocks, right? I could add that here, right? I could add like SpaceX or something else. I could see like what else is improving outside of just these momentum. So there you go. So that's how you would use it. That's how you would use it. Yeah, this tool. But yeah, don't spend too much time on this. I would say just don't spend too much time. Stock charts also has like a scooter ranking here, scooter ranking. So you could judge this based on his peers. There's definitely a lot of different ways, but this is the traditional way. You just look at the ratio, right? But I think this is a lot more detailed. The way he computes the ratio is like you could see, yeah, it's getting weaker, right? It's getting weaker compared to the S&P 500, getting weaker compared to the S&P 400 mid cap, S&P 600 small cap. But here you can see quite clearly we are losing a lot of power right now. And I bet I could just find somebody else that looks like it's going to take over from XLK and go over there instead. So, yeah, you could do it. And that's where the scanning comes in. You could use scanning to help you figure that out. But right now, yeah, I don't think you got to worry too much. I would rather wait until October to really worry about it. Do you ever buy XLK or the others? No. I just buy QQQ, S&P, right? Type stuff. That's it. And you know, people buy other ETFs, right? You know, VOO, they have less expense. QQQM, Kyle mentioned QQQM. You buy and hold, it has less expense. Fees, you know, percentage fees or whatever. Up to you. But that's usually what I do. I'm so lazy, I just do that. Why does it matter? I don't need to do this. This is just for to help me figure out what to trade. So anything that I buy and hold, I'm just gonna use the straight index. I'm not gonna just buy like XLK, XLI, or no. I just buy a straight index. Don't think about it. That's it. Yeah. Yeah. So that's it. But you can practice with XLK, XLC, whatever. You could try this, right? You could say like, if I pick the best, like let's say I just want, let's say I do this for practice. I make a portfolio where I only change every month, one time or something, make a limit. So I pick the 3 ETFs of the S&P 500, 3 sectors that I think are good. And then, you know, based on that, maybe I just do like the top one gets 2/3, of my money, and the other 2 just get like the rest, you know, or something like that. Who knows? You can make some little rules like that and see if you can win. See if you can win. And all you do is you just figure out based on charts, the relative rotation graph, anything. And you can say like, okay, next quarter or next month, I think this is gonna win. So I'm gonna put all my money over here and see if you can do better than the S&P 500. If you can do that, okay, you're good. Right? I think that's gonna be a tough thing to do though. A lot of people can say that's easy to do, but I don't think it is. Because you limit yourself with just like the ETFs, and so it's good practice. I think that's good practice because a lot of people probably can't do it. Most of my like trading gains is from like picking out individual stocks, right? Like Palantir goes up 10 times. You're not going to get that from an ETF. Okay? So it's more challenging if you just use ETFs and say like you can beat the 500. That is hard. That is hard. And I already showed you the performance from earnings beats from that Tom Bowley guy last week as an example. Like, can you beat the S&P 500? That's like by itself is a challenge for most people to do consistently. So if you look at how he does from 2018 or 2019, he's done quite well. So he's beat the S&P 500 from that period, right? So 400% here. S&P at the same time only did 180%, 274% versus a 164%. All right. So actually, his aggressive portfolio didn't beat the S&P 500 as much as his more conservative portfolio. And now this is even more conservative right here. You just do ETFs. So this one, he just uses ETFs. He uses like SOXX, XLK, you know, like XBI, right? So he just uses ETFs. No cheating though, no leverage ETFs. I don't think he uses leverage ETFs. But you can see like he only made like 103.96% from October of 2020 versus the S&P at the same time, 116. So that's why I don't bother with XLK. If I'm gonna buy and hold an ETF, I'm just gonna buy the S&P or NASDAQ 100 ETFs. Like, I don't bother with trying to beat the S&P 500 by saying like, oh, I know when to buy and sell XLK, XLI, XLB. Nope. Right? What's your setup on sharp charts again? What's the point of those again? Oh, that was just this is just like just to show the relative performance. That's it. This is it. Right? Between like large cap, mid cap, small cap. So that's all I did here because I could just do this for any other chart, right? I could just do like this like ITA, right? Like you wanted. Here's ITA divided by S&P 500, ITA divided by S&P 400, ITA divided by S&P 600. So large cap, mid cap, small cap, right? And then see how if it beats the performance. And then down here, all I did was just add the Julius de Kempener RG stuff here. That's all I showed you with this, because I just showed you this using this here. That's it. See, I could add ITA right here. Can I add? Yeah, add it. Or did I run out of symbols to add? I guess I ran out of symbols to add. I don't know. Okay, here. Right, ITA right here. See, ITA was already improving in It looked like December into January. So yeah, somebody already knew what's up, right? You can look at oil the same way. I'm pretty sure somebody knew there was going to be a war, and they were already like itching to buy, and they were getting more aggressive into the new year. So you can see like there compared to everything else. So let's see who else was the winners here. You got this, you got materials, industrials, and staples all competing at that same time, late February. So we're going to January. This was improving in terms of the ratio, and they had high momentum. So somebody was aggressively going in there at that time. Did they know there was going to be a war? Probably. So that's probably why it was all happening like that. So yeah, that's all I'm saying. That's all I'm saying. And so you can see the same thing here. As we get into 2026, you saw like the ratio increase. So that's why this red started moving up a lot. So this was kind of like maybe a tell, right? A tell that something was happening. So there you go. All right. Okay, that's done with that. Okay, that's enough. Okay, I was gonna cover some stocks here. So I covered HIMS a little bit, right? mRNA. So I'm gonna cover a few more. And I guess that's it. I probably have some. Oh, I was gonna talk about the SpaceX leverage ETFs a little bit. Okay, I have some time. Okay, AXTX. Okay, so let me get that. Okay. So let me remind you, HIMS. Okay, good. Was doing good. Okay. Yep. So this one definitely. I like. Oh man. So we see like XLV wants to improve in terms of relative performance. Does that mean this stock is something to buy? I don't know yet. Maybe. I just feel like you're just better off gambling in the semiconductor stuff right now, or the AI infrastructure for as long as you can. We have to get through the options though, but it does look good. Yes, I cannot deny it. That's looking far better, but at the same token, it doesn't mean that we just can't just keep going sideways for a while. So mRNA, yep. HIMS, yep. They all have leverage ETFs. That's also an option for you guys. But again, we already tried that with the hantavirus, and it was like, well, we didn't break out, so no go. Waste of time. Didn't go anywhere, right? Okay, AXTI. So let's look at this. So somehow I put this on the list. Why did I want to look at this? Okay, I see. I think it's because this one went below the range, went below this resistance here, right? We recovered, but today we failed. So, this is one of those stocks that like could be a very good bubble, right? It could continue. But this change in behavior here, if it continues on into next week, deadly, very deadly. That means we are going to puke. Now, that might not be a bad thing, because if this thing does go and make a bigger sideways range, then you have an opportunity to start buying at these lows. Because eventually, when the bubble continues into November, probably, or December, then whatever you buy here eventually will break out. So we have to prepare. So we're going to prepare for a range. If it does make a range, then we're going to start looking at how it builds its range and then get ready for the next move up, because this range will be very nice. You know, if you pick out like at the 40s or 30s and eventually it cracks above 130 again, 140 again, then it can continue up. Yeah, you'll get a good entry, right? One of these spots will be the good entries. Maybe it'll break out here. Maybe it'll break out right away here. I doubt it. If it actually does break down here, it's gonna take a while. It's gonna take a while to finish off. So probably into like October, November, December is when the final, bottom is. But of course, it doesn't have to go all the way in this range, right? Like it could just do this before going up. Like it makes two very low lows here, it makes higher lows here before we break out. I don't know how it's gonna look. I don't have a crystal ball. But I'm just saying, like, pay attention. How does it build its range? How it goes forward? We can see what the Wyckoff thing looks like. We can imagine what it looks like. But for now, it's like looking at this candle, it could be the start of the end. This looks like a nasty failure here. Nasty failure. So watch AXTI. Could be an opportunity for later. All right, AXTI. Okay, next one, Oracle. So far, Oracle, I haven't heard anything with the bond market. I don't know if it's gonna crash and burn everybody else. So far, nothing. But it is stuck in this upper range, right? So we know that this price here, 190 and then 127 were very important. So does it do that, or do we just get stuck here forever before going down? So that's what I'm wondering. So this is why the software sector, IGV, all that stuff, I don't know, it looks terrible. Looks terrible to me. I mean, next one, Palantir. Bro, this looks horrible. How many times have we danced at this 120 something level? Really, I'm just gonna assume that you have to go lower, because if none of this thing resolves in an up move, we just stay at this bottom of this range, then the likelihood of it going down increases. I don't think this is like semiconductors, because semiconductors kind of did a similar thing, right? Where if you look at here, we had this range here, and then at the end of the move, it was going down, right? We were at a lower level. We stayed at the lower half of the range. So if we go look back at like Palantir, do we think like that's what's going to happen? Like there's going to be a false breakdown, like whoop, and then all the bears come in here thinking it's the end of the world. It's like, yeah, this is a great place to short. We're going to do it. Or is it going to fake out and just rocket up like semiconductors did? Because that's similar, right? You have a big range, and now you're staying at the bottom half of the range. You're not hanging out at the top half anymore at the beginning. And then you kind of tease people like you're going to break down. And then you trick people here to thinking like we're just going to go straight down to $70 or $60 again. If that's the case, then I would be carefully watching if this is a false breakdown, and then it's just going to be the fuel you need to finally escape this hell and get up. So that's why patterns matter, right? You can see patterns. This is a similar pattern to what we saw in semiconductors back in January, February, March. But this one is from like August to June of this year. So August of last year. So this is like a bigger, wider version of what we saw in semiconductors. I'm not saying it's going to happen exactly like that, but I'm just watching you. You know, I'm just trying to put your mind at work here and going like, well, what pattern is this. You know, for the near term though, this is not very bullish, right? I mean, this whole move where it just goes up and goes back down, this is not good. Semiconductors never did something like this. This thing here, ugh. So I can't tell you. My bias would be bearish, but again, like you could get tricked, right? You could get tricked. I don't see a lot of volume coming in, so I turn back a volume here. I, this is okay, whatever. No, I don't see any kind of like signal there, so I can't tell you. Okay, next one, CoreWeave. So we have to talk about CoreWeave again after it got added to the NASDAQ 100 on Friday. So CoreWeave, okay, it's trying to come back. So we've kind of been like, well, this is a dead stock because it kind of is the weakest out of everything else. Like HUT, CIFR, you know, NBIS is doing better than this. So now that it's added to the NASDAQ 100, that's why I said, like last time on Monday, I said like, well, it looks like I think you got to watch this. Doesn't matter if we hate it. Doesn't matter if all the people say it's fundamentally broken. It has bad debt. It's ugly, terrible stock. Well, it got added to the NASDAQ 100. So that means people are going to be buying it anyway if they buy the QQQ, any of the ETFs, any of the index. If they got mutual funds with a lot of like NASDAQ 100 stocks, they're going to be adding this too. So we have to pay attention again. So this thing could break out. If this thing does break out, it's doing good. So this past 2 days, it's probably one of the best performing stocks, right? Better than semiconductors right now because it had 2 green days. Monday and Tuesday were green for CRWV. So CoreWeave, yeah, we have to add it to the damn thing. We have to add it to the list of things you have to watch. All right, last one, Sienna. So the optical stocks did not do well today. So just like semiconductors, these optical, photonics, laser stocks did not do well today. And this is not good. This is one of those companies that had earnings, and ever since earnings, it's been staying down here. Last time it had earnings, all right, it went down, but it quickly recovered. Look at this. Look at this. Look at this. Is it just going to do this? So this kind of has me thinking, like, well, is this a prelude for the other, like, optical stocks? Optical stocks, memory stocks will be the first ones to show weakness, I would think, if before everybody else in the AI stuff. AI hype, you'll see the weakness here pretty readily. So Coherent, let's see. Lumentum looks okay. Coherent looks okay-ish. But yeah, I think we could see some slowdown here, right? I think this is pretty much, we could see some slowdown. Like the trend looks like it's about to fail pretty soon. A couple more red days on these type of stocks will pretty much do it. And they're volatile. It won't take much for it to just completely puke here, right? That's what my guess is. So yeah, I don't know. Its trend is still okay. Lumentum's more of a sideways now. It's like Lumentum's definitely more of a sideways. Yeah, this one has a more sideways look, just like AOI. Yeah, this is gonna be important. I don't know, the size of these red candles too. Like you could see the weakness. It's just like, man. One bad move down, like let's say a gap down here, somewhere here, and then all of a sudden your red DI would just fly up. Yeah, so That would happen, wouldn't it? ALMU. No, this one is so bad. I don't know. So bad too. Anyhow, okay, that's it. So I will be watching that carefully, because there's kind of a sign that something's gonna occur that I would not like. Okay. All right, good. Covered that all. All right. Now let's look at the SpaceX leverage ETF. So I mentioned on Monday that they would, or it was like Sunday night, Monday morning. I said like they would start trading Monday, right? And so we started trading on these SpaceX ETFs. So let's look at them. So far we have these ETFs here. Okay. So SpaceX, SPCX, this is where it's derived, all right, from. And we don't have much data, right? We just got our IPO on Friday. We don't have much data. We have no data at all. This is all we got right now. This is all we got. This is the only data we have. Let me see anything else. No, that's it. That's all we got. This is the only information we have. Now we have these ETFs. These are the long ETFs. Okay, these are all 2x leverage, I believe they are. We have the Pro Shares Ultra SpaceX ETF, SPCF. We have the Direction LOFF. Okay, we got that. We have the T-Rex. Okay, SPAX. We have the Defiance, SPCU, and then we have the Granite Shares, SPAL, and we have the Trader, SPCM. Okay, so you will ask me like, which ones do you pick? I don't know. I think the Pro Shares and the Rexion is probably the ones with the most volume right now. So I guess I would just say like, well, if you want to trade them, this is which ones you get. So I think, yeah, these two have the most volume. The rest probably less, or I don't know. Actually, T-Rex is pretty good volume too. Okay. Okay, so T-Rex one. Yeah, okay. Well, I guess the one with the biggest amount of volume is the Pro Shares Ultra SpaceX, SPCF. So I guess you go there. Now, we also have 3 inverse ETFs. So if you want to short the SpaceX, here you go. You don't want to use options. The options market now has SpaceX 600,000 options volume already traded on Tuesday. So they opened up on Tuesday for SpaceX options. So let's see. But then you can use the ETFs to short it as well. You could use the SPCQ Defiance Daily short, 2x short. You have the SNK, okay, Granite Shares 2x short, and then you have the SPCG, the Trader 2x short. So you have 3 2x leverage short ETFs to inverse it out. So if you want to short SpaceX, you can use that. So this is a way for you to trade without using the actual shares. I believe I already covered that a lot of brokers do not like it if you just buy SpaceX and then sell SpaceX and then buy it back and sell it again. And you definitely can't short it right now. You can't borrow shares to short it right now. I'm pretty sure you can't find any. You have to use options. So for you, those of you guys that want to trade but can't use options, your leverage ETFs is the way to go. Okay, so yep, this is definitely day tradable. Definitely day tradable using this stuff right here. All right, good. That's all I gotta say. 2 hours, perfect. Let me see what I have here for a video. I do have some videos that I probably will cover tomorrow. I'll probably try to come in the morning, okay, sometime in the morning, before what Kevin War speaks. So at the open, the VIX futures will have a lot of shake. That'll definitely shake up the markets in the morning. So you gotta watch out for that. You're probably gonna have some crazy old crash or something like that. So let me see. We'll get the video here. So I'm gonna preview some of this. right now. So let me see. All right, so let me play the options one. I think that's the most important one to get to.
All right, so June OPEX is coming up in both VIX and SPX. While it's not completely clear, we're going to leave behind some key influences that will no longer be driving the market, and the change might produce a little bit of instability. I'll walk you through the positions that are expiring, as well as what I expect next in this video. So as I discussed on previous videos, the positioning in July is anything but normal. It's maybe resolved a little bit. There's some big positions that were far to the upside that were putting a lot of pressure on market maker books that have moved. But in general, there's still a lot of tension on the market maker books. Once this expiration rolls off, we're going to lose some gamma, and we will continue to lose some of that gamma as we move forward in time and expire the daily positions behind June. And the only problem I see ahead is that the positions in July are not clear. There's a lot of ambiguity in what customers are expecting. And in my experience, when you have a lot of ambiguity, meaning no clear concentrations, you sometimes get things that look worse than negative gamma. Because at least negative gamma means customers are hedged, clearly, produces ranges and influences that are kind of tractable. There's sometimes balancing and prediction there too. But when they're unclear, when everyone has a different opinion, when customers are hedging different levels like they are in July, all across the board, to the upside and the downside, it produces instability. And so what I think is going to happen next, we become unglued. This is almost a traditional OPEX ungluing. And I think that the market might be a little bit more volatile. Volatility itself might be free to float a little bit higher. And as it does, don't expect the market to tank. I'm not saying that. Just expect realized volatility to pick up. And eventually that might produce the same sort of topping signal that we flagged ahead of the crash from 7,600 2 weeks ago. Yeah, so most importantly, I feel like right now, between the levels we're at right now, there's this tendency to produce a little bit of a balancing act at 75.50, roughly, 75.5. We left this range before, which had its own balance of 74.30. Now it's shifted up. This is artificial. It doesn't have anything to do with this real bullishness, which people associate it with. It's actually just mechanical. It's all these options here. These calls that are now in the money are going to be 100 delta on Thursday morning. And so this is the process by which we have to buy more and more futures just to keep the position neutral as they expire, and then they disappear. When they disappear, we're going to have the ability to loosen up again. But up until that point too, we're going to be driven by what happens in volatility. But to be honest, to a lesser extent, we're at a range now where vol has come down a lot. It can actually float a bit higher in this range, and it won't make the market sell off, which is not usual. This is almost like that spot up, vol up, where we can get this weird thing where we drift a little bit higher and vol comes up, and that's okay. July positioning is hedged kind of everywhere. It's not like a normal position. It doesn't produce this drift higher. It's going to be a moment once June expires and once vol starts to come a little bit unglued, depending on what FOMC has for us, what this new chair says. If the market experiences it as kind of risk off, it doesn't mean we automatically go down right away. We might still get a bit of a weird knee-jerk type of rally that's not stable, like we had experienced over the last month as well, over and over and over. So my view is that what we just went through was we were balancing here, and this position in the VIX was very important here. VIX kind of drifting higher, but the problem with that was that if the VIX created a reason for those market makers to buy VIX futures, that pushes the prices of the SPX options higher as well. When it does that, it makes these market makers have to sell futures. And there was the risk of losing this important level in the June inventory, 73.5, where if we lost it because of that function over there, the market would have gotten kind of trapped here. And all of a sudden, we start to grind down and trend lower. And it starts to actually put a knock into the whole momentum picture, which is bad for the market overall. So it was really, really important. I would never say it's manipulation, but it sure feels like it's very technically precise and beautiful sometimes, that they step on the headline gas when the market is right there at this key inflection in our framework, where if we stay above this vol level, we have VIX or Vega to buy, vol up and spot down. But pressing below it helps the market make a new target in vol. No matter what people are doing or what they care about, the market makers will sell VIX futures down to this level. And if we go below it, they'll have it to buy to that level. So that helped us break this range and take this risk off the table, importantly. 73.5 was no longer really in play because we punched through here and escaped the gravitational pull towards 74.30, which was very much in play last week. In fact, Friday, after we did our content, we had pinned this level. But breaking through here turned all this pressure that would have caused dealers to sell futures to this level. It just erased that and actually flipped it on its head to the point now where we're just levitating. And all this decaying option premium creates this need to buy futures towards almost exactly where we are right now. And so all this kind of range stuff gets a little bit reset after Thursday, but into Thursday too, we still have VIX expiration on Wednesday. So when this position disappears, so too does its influence. And this pinning that should happen somewhere around 17.5, no longer in play. So a couple of things happen. The market will loosen up in general, and also volatility can do whatever is a function of real order flow. No longer is it constrained by what market makers have to do into tomorrow's AM VIX expiration. It's free to move about wherever levels people think is relevant. So what happened when we escaped this range to the higher range? Again, the whole area here in the vol complex was 20 to 25. That was taken off the table at the same time. And so sometimes we get these big headlines. The best way to play them is not necessarily to trade long-term vol or to trade VIX instruments. It's actually to understand what this causes for this market, because this market's one you can trade with the cheap zero-day options with a lot of leverage. And we see influence all day, every day with certain ranges. And it's much more approachable for most traders. This view that we use here in VS3D, this is not technical analysis. This is not any guesswork at all. What we love so much about this is it's as close to insider information as you get, because you know one of the largest cohorts in the market has something that they need to do based on their position. And what they need to do is very simple when you understand the option mechanics behind the model. Very basic. You have option market makers that have positions built with puts and calls. And these out-of-the-money options have delta, and they're hedged in real time. When the actual vol surface changes, the deltas of the options changes because the distribution shifts. And so these areas here are key to follow. Whenever you hear the word skew, you hear the word Vanna, risk reversal, spot vol correlation, the most impactful thing as far as market maker hedging impact that actually moves the futures, that moves the equities, is all about which positions they have at these places on the curve. And when you understand this, you can trade without a view at all, or, and very key, at least in my experience, was this informs your view. I used to trade a lot of macro ideas. I had a lot of reasons for the market to go up or down, and I wasn't always correct. And the most frustrating thing was when I was correct, I was often mistimed until I understood how much power this had. And remember, I was a market maker myself, and it took years to figure this out. So don't feel bad if it's confusing. But this is what we do every single day, and I've had better outcomes myself than ever in my entire career. And so for today, what do we see until tomorrow? This is VS3D. So the profile that we have here is the literal zero-day position that's held by market makers. What do I mean when I say held by market makers? It's not open interest. There's no guesswork here. We pay the CBOE to understand exactly which volume comes from which entity and which direction, because it's not only important to know which way a trade went, but to know who bought or sold the option. Because if I trade with one of you guys in my capacity as a customer, we just cross markets, it produces nothing. You go about your way and check your position every couple of days, and I do the same, but we're not hedging it. And so there's nothing that we can observe that gives us an edge. But if I trade and the other side is a market maker, and that market maker has to hedge the position to keep their book flat, it's an entire different ballgame. Now, when you know this model behind the hedging, you actually understand the bias and the flow. And so for today, for example, we had a very clear type of prescription. They won't always be this good, but sometimes, especially on days when we understand that there's probably some reason for the market to be still, these things can be a really big chunk of the volume. For today, for example, using this data, what we saw in the morning was a clear test. Now, in my framework, test means something. They're usually customer hedges, which show up as market maker shorts. When a customer buys a position, whether it's a put or a call option, it shows up on this side of the VS3D dashboard as a short option position for the market maker at a particular strike. Now, I know the numbers might be small here, but I'll do my best to articulate what I'm pointing to. You can sign up for a free trial yourself for 7 days to VS3D and follow along with me live or in our Discord and in our Q&A for yourself. Full access to the data for 7 days. But what you see here is this cluster of hedges, customers' own options at 75, 60, and 65. Now, the next series would be somewhere down here around 75, 35. And what this does for us is it creates a range. Now, inside of these ranges, there's usually what we call a balance point in our framework. This is what we talk about every single morning in VS Pro. We use the data from VS3D to figure out where the range points are and where the balance is. Again, it's not TA, and it's not just pretty lines on a chart, although it does produce really beautiful charts. It is actually prescribed flows because, importantly, I'll keep it very simple. Imagine you're the market maker that has sold this call up at 75, 60. If you sold this call, you have to hedge it in real time. So you guys watch your delta change on IB or Thinkorswim all day, every day, and it moves 30, 32, 35, down to 24. Imagine you had a hedger always buying and selling futures in the background to just keep your overall delta paired, neutral. Now, these options expire today. So if we're just below here at 75, 50, or 55, this call option here that you sold to a customer and maybe bought thousands of futures against doesn't need any futures when it's an expired option. And so what happens then, you get trapped in these ranges, is it produces reversion towards some anchor or balance point. And usually, almost always, that balance point happens to be a market maker long. So while it's popular to assume that there's some cabal of market makers that know exactly where you bought your options and will make them go to zero, it really works the opposite, where we land on our options. That's because all the buying and selling that happens in these ranges points back to our biggest long in the range. And so our framework every morning in VS Pro is to use this data to figure out where the market may go, not because we think that it tells us exactly where it's going to go and when and why, but because it gives us bias. It gives us a way to understand what's more probable. We no longer have randomness, we have a weighted coin. And you can still lose money with a weighted coin, don't get me wrong. And nothing we ever say is financial advice. You have to trade your own risk and your own style. But when you pair data that really gives you an advantage, because again, you know where buying and selling is happening in a range with a shot clock on it too by the end of the day, it gives you an advantage that a responsible trading strategy should easily be able to exploit without ever thinking anything about what's going on in headlines, macro, anything of the sort. So today's outcomes, if we stay within this range, all point back to, in fact, a very boring finish, right where we finished yesterday, 75, 55, or 75 half, which in some sense makes sense because why would anybody make a big decision or commitment ahead of tomorrow's Fed meeting? And so again, I couldn't have told you that we would bounce here at this level or we should finish at this level. But even just here on the call, while I was doing this with you live, you witnessed yourself that the market dropped down to our test level that I was explaining and bounced. And now it's on its way back to what I would call the balance point. May not get there, but these influences show up every single day, no matter what kind of market it is, busy, slow, volatile, or not. We get actionable influence out of knowing what market makers have to do because this is their position. And so again, I encourage you guys to sign up for a free trial.
All right. Well, because of all these stupid little options, you see, we bounce and bounce back and forth in ranges. We get stuck in these little boxes every time. So when we went gapped up on Monday, we went to another box, basically. That's what he said. He essentially said, like, we just went to another box.
Fall up where,
okay. So he drew this 7,500 here, these red lines. Like, if we did not bounce, if Trump did not taco, there was a chance that we could have like broke down below 7350 on the S&P and went down lower. That was like the possible thing before the VIX expiration. So tomorrow we'll have VIX expiration. So these boxes in between the 7,500 will just start disappearing. 7,500 and 7,400 will start disappearing, I guess. And so we'll probably just melt up into the meeting, and then once the meeting happens, maybe he'll say something good or nice or bad and scary. I don't know. Depends on the market. And then from there, we'll just like try to do something into Thursday with the market expiration, like OPEX expiration, all the expirations up on Thursday. In the end, we're just gonna be stuck in these boxes, I'm assuming. Yeah. But we'll see. We'll see. So I'll try to come back just before Kevin speaks. And then after Kevin speaks, we'll go over it at night. We'll discuss what the market tried to do, you know. But I'm guessing we won't do too much outside of hanging around 7,400, 7,500, I think. I think all these things will have to clear out on Thursday. And then we'll have the Juneteenth holiday for the markets. So the market will be closed on Friday. So we'll have to wait for Monday to see what's up. After that, so 3-day weekend for the markets, and then we'll continue on from there. So pretty annoying stuff. Yeah, with these options. You can see like how much these things control things. So like he said, it doesn't matter what the news was. It's just because the options market, there was a mechanism there already in place for it to do something. Just like that Friday when the market just puked and everybody thought it was because of interest rates. And it's just like, dude, interest rates started improving and you still didn't bounce anywhere. You just kept going like sideways to lower. So it had nothing to do with interest rates in the end. It was just like we were getting closer and closer to the options expiration. Oh man, really how it is, I guess. That's just how we have to survive now. We just have to survive through all that. So without these options, you know, it would just be a lot easier. But because of options, like we get trapped. Like HUT could be at 150, 160 now, but because of options, we have to wait for everything to clear out. You know, it's like a clog. Every time you just get somewhere and then you just get stuck because there's a clog in front of you and you just have to wait for the clog to clear out. So, and it's going to get a lot worse. It's just going to get a lot worse as we move on and more people use options. I think definitely from COVID on, we had these, it just started increasing. So let me show you this stuff here. You see this? So I'm guessing you guys don't know what skew means. I'm not going to teach you that. And I'm not going to teach you about the inversion of skew. So there's something called a smile. So the skew is like, let's just think of it this way. You know, there's a curve. It represents like the puts and calls. You know, I kind of did the put and call ratio, so it's kind of like that, but not like that. So usually there's a smile. Okay, that's what you would say, like, oh, it's a smile. The skew is smiling, but now it's frowning. It's frowning right now. It's inverted. It's frowning. So in that case, we have a different scenario. When was the last time we had a lot of stocks in the S&P 500 and NASDAQ 100 that was frowning? We had this inverted volatility skew. Well, the last time we had it was 2021. Okay. And I actually asked AI to see if, do you have data for the .com 1990s, late 1990s, early 2000s? Do we have the skew data for that? And they were like, no. It's only very recent we had such a detailed analysis of options for different stocks. But there was a research paper. And it did say that there were a lot of stocks that did have this inverted skew, but they were the garbage stocks. So they weren't like in a NASDAQ 100 or S&P 500. They were just like pets.com, you know, like all the other stupid .com stocks. They had this issue. But because they weren't inside the S&P 500, NASDAQ 100, nobody cared, right? So overall, the NASDAQ 100 and the S&P 500, even during the bubble of that period, during the .com, only 5% had this inverted skew scenario. So what this means is, like, if we see this, there's a bubble. We see this now. Semiconductors, yes, there's a bubble. We see there's a bubble. Who cares though, right? If we look back at the .com, luckily they weren't part of the NASDAQ 100 or S&P 500 in any significant area, so they didn't cause a problem. You know, even though we did have a crash, in the .com. So the next time we have a crash, I'm guessing it's going to be a lot bigger than the .com. So the bubble could be bigger and the crash will be even bigger. So because of all these options, right? We see the options now dominate. So we should be able to make a lot of money on this bubble, more than we had in the 90s. So if this is just a prelude to what we're going to see, so we're going to have like the bubble of the 1990s plus the options market of the COVID-19 plus, you know, etc. SpaceX plus Anthropic plus. So we have all these new ingredients going into one massive super bubble. Then we should be able to make a lot of money, I'm guessing. Anyway, next week, apparently the CTAs, so these are the algorithms, okay? So these are the automatic trading algorithms. After the options expire, I guess this is what's going to happen. It doesn't matter if we have good news or bad news. Next week we should be heading down, I guess. That's what it's saying. This is what Goldman Sachs says, so I don't know if these guys are right or wrong, right? Like I said, all these guys have inside information. They know everything. They know what you got. I don't have that information. All I can do is read free charts from TradingView and stock charts. So you're going to have to trust that they're giving you the correct information, though. They could just be giving you this stuff to get you scared for next week. I don't know, but there you are. All right. The other thing too is that with all these companies trying to issue more shares like Google, okay, so we are at a point where companies, these big tech companies, are no longer buying shares to prop up the share price. Now we're seeing this point here where they're actually selling more shares of stock than buying them. So that could also add pressure in the near term. So watch out. In the coming months, I'm guessing it's not going to be easy for the stock market just to go up, okay? So my bet is July into August, we're going to struggle. We're going to start struggling. And then we start rolling over into September when everybody comes back, you know, to trading. They're all in vacation right now. It's summer vacation. Most of these guys are not around. But by the time September and October come around, yeah, they're going back to work. And they're going to be like, it's time to crash the markets. Probably time to crash the markets at that point. They got to sell shares, you know. So we'll see you then.